In Part 3 of Lesson 1, we discussed how to look at the S&P using market internals, specifically the percentage of stocks trading above their 200-day moving average. In this part of Lesson 1, we will look at the ratio of puts to calls. Typically, large institutions use options to hedge their positions. When they are buying stocks, they will purchase call options to help keep their entry costs down. Buying pressure will force a stock up, so they will often buy calls on that stock prior to beginning the purchase of the stock. Yes, this would be considered a hedge. When they are concerned about a stock going down, they will purchase puts to help protect that position. We can use this information to get a feel for the level of concern on the part of the big institutions. Since they move the markets with over 3/4 of the volume on the exchanges, it makes sense to understand how they feel. This can be done on the index level and at the individual stock level. Let's look at the first chart. This is the equity-only put-call ratio. This chart tracks the total of puts and calls on a daily basis for all of the equities, stocks, not futures, traded on the exchange. The puts are divided by the calls and gives a ratio. More put buying than call buying will make the number go up. In and of itself, this is just a bunch of squiggly lines, so let's do some analysis. Notice the overall trend of the chart appears to be down. If you connect a trend line across the peaks, they're moving down. Now let's add some context. If I added the S&P 500 to the top of the chart, now you can see the downtrend in the put-call ratio tracks nicely with the uptrend in the S&P 500. This would make sense that as stocks moved higher and confidence increases in the bull trend, the amount of protection purchased would remain low. Finally, let's see how we can tie the data in these two charts to create information that can help us understand what is happening or about to happen. Between the two charts, I've added what is called a percentage price oscillator, the PPO. The PPO measures the percent change in the equity-only put-call ratio. I've also added colors to highlight two areas on the PPO. The green color band shows when the PPO is above +10. This level suggests the put-call ratio has moved too quickly to lower levels. This area we will call extreme optimism. Many are too bullish on the market. The red color band shows when the PPO is below -10. This area shows the put-call ratio has moved up very rapidly to high levels. This area we will call extreme pessimism. The normal range for the PPO is between +10 and -10. When the PPO moves to an extreme level, that may suggest something is going to happen. Art Hill from StockCharts.com adds another observation, and I've included the blue arrows to point it out. Art observes that when the PPO moves to an extreme pessimistic position and then starts to move back up, this often corresponds to a reversal in the market. He also observes that the PPO is better at pointing out market bottoms than market tops. So we are using this new information to look inside what is going on with the markets. This is why we call them market internals. Once again, technical analysis studies the change in behavior of market participants. When they all seem to think the same thing, that is a recipe for change. In the last part of Lesson 1, we will look at volatility. If you want to learn more, you need to like my page and follow it. You don't want to miss anything. Until then, this is Doc saying stay hedged.